Want to know the secret reason why so many fixed income investors end up losing money? It's not what you think. They follow the so-called safe advice, but they miss the hidden traps that can drain their returns. Today, I'm going to pull back the curtain and show you the biggest don'ts of fixed income investing, step by step. Stick with me, because by the end of this video, you will be able to spot these pitfalls from a mile away and protect your portfolio like a pro. Let's dive right in with the first and most common mistake. Don't chase the highest yield without understanding the risk. It's so tempting, right? You see a bond offering a 7 or 8% return when everything else is offering for... It feels like a no-brainer. But hold on. That high yield is almost always a signal of higher risk. Think of it like a warning sign. The company or government issuing that bond might be financially unstable. There's a greater chance they could default, meaning they can't pay you back. So, instead of just looking at the flashy yield number, you need to become a detective. Look up the bond's credit rating from agencies like Moody's or S&P. A RRR rating is the gold standard of safety, while anything below BBB is considered speculative or a junk bond. Chasing high yields blindly is like running into a dark alley for a free wallet. You might get lucky, but you're more likely to get into trouble. Always ask yourself, why is this yield so high? The answer will tell you everything you need to know about the risk you're taking on. Next up, a mistake that can silently eat away at your purchasing power. Don't ignore inflation. This is the quiet killer of fixed income returns. Let's say you buy a bond that pays you a 3% coupon. You feel good about that. But if inflation for that year is running at 4%, you've actually lost 1% of your money in real terms. Your dollars can buy less than they could before. It's like running on a treadmill. You're putting in the effort, but you're not actually moving forward. So, what's the solution? You need to think in terms of real return, which is your bond's yield, minus the rate of inflation. To combat these, consider investments like Treasury inflation-protected securities, or T. The principal value of these bonds adjusts with inflation, so your returns keep pace with rising prices. Ignoring inflation is a guaranteed way to become poorer over time, even when you think you're earning a safe return. Always keep an eye on the inflation rate and factor it into your investment decisions. Let's move on to our third big don't. Don't put all your eggs in one basket. I know, you've heard this a million times, but it's incredibly important in the fixed income world. Some investors find a bond they like, maybe from a company they know, and they pour a huge chunk of their money into it. This is a massive gamble. What if that single company runs into financial trouble? What if that specific industry faces an unexpected downturn? Your entire fixed income portfolio could be wiped out. This is called concentration risk. The key is diversification. You should spread your investment across different types of bonds. Mix it up with government bonds, corporate bonds, and maybe even municipal bonds. Within corporate bonds, diversify across different industry stack, healthcare, consumer goods, you name it. And don't stop there. Diversify by maturity dates too. Having a mix of short-term, medium-term, and long-term bonds creates what's called a bond ladder, which can help you manage interest rate risk. Diversification is your best defense against the unexpected. It's the seatbelt for your investment journey. This brings us to our fourth point, which trips up even experienced investors. Don't misunderstand interest rate risk. This is probably the most confusing part of bond investing for many people. Here's the simple rule. When interest rates in the market go up, the price of your existing, lower rate bonds goes down. Why? Because no one wants to buy your old 3% bond when they can buy a new one that pays 5%. To sell your old bond, you'd have to offer it at a discount. Conversely, when interest rates fall, your existing higher rate bonds become more valuable. The mistake many people make is buying long-term bonds right before a period of rising rates. A 30-year bond is far more sensitive to rate changes than a 2-year bond. A small increase in rates can cause a significant drop in the price of that long-term bond. So, how do you manage this? Pay attention to what central banks like the Federal Reserve are doing and saying. If they're signaling rate hikes, it might be a good time to focus on shorter-term bonds that are less sensitive to these changes. Understanding this relationship is crucial for not getting burned when interest rates start to move. Our fifth don't is a behavioral one. Don't panic sell when bond prices fall. We just talked about how rising interest rates can cause bond prices to drop. When investors see the value of their bond fund go down, their first instinct is often to sell everything to stop the bleeding. This is usually a terrible idea. Remember, if you hold an individual bond to maturity, you'll get your full principal back, plus all the interest payments along the way, assuming the issuer doesn't default. The day-to-day price fluctuations only matter if you sell before maturity. Panicking and selling locks in your losses. Instead, take a deep breath and reassess. Is the reason for the price drop tippery? Is the underlying company or government still financially sound? Often, a price drop can be a buying opportunity. You can pick up quality bonds at a discount, which increases their yield to maturity for you. Unless the fundamental credit quality of the bond has deteriorated, your best move is often to stay the course or even buy more. Emotional decisions are almost always bad financial decisions. Let's talk about the sixth mistake. Don't overlook the fees. This applies especially if you're investing through bond funds or ETF. Fees, like inflation, are a silent drain on your returns. They might seem small, maybe 1% or 1.5%, but over 10, 20, or 30 years, they can consume a massive portion of your earnings. Think about it. If your bond fund is earning 4%, and the expense ratio is 1%, you're giving away a full quarter of your returns every single year. The power of compounding works for fees too, but in the wrong direction. So, what should you do? Always check the expense ratio of any fund you're considering. In today's market, there are many excellent low-cost index funds and ETFs that track the broad bond market for a fraction of a percent. There's rarely a good reason to pay high fees for a simple bond fund. Do your homework. Compare the costs, and choose the most efficient option. Keeping your costs low is one of the easiest ways to boost your net returns over the long term. Now, for our seventh critical, don't forget about liquidity. Liquidity simply means how easily you can sell an investment for cash without affecting its market price. Some bonds are highly liquid, like US Treasury bonds. You can sell them almost instantly. However, other bonds, like some municipal or high-yield corporate bonds, can be very illiquid. There might not be many buyers, and if you need to sell quickly, you might have to accept a much lower price than what the bond is actually worth. This becomes a huge problem if you face an unexpected emergency and need to access your cash. Before you invest, ask yourself, how quickly might I need this money back? If there's a chance you'll need it in the short term, stick to more liquid investments. Don't tie up your emergency fund in an obscure municipal bond that could take weeks to sell. Always match the liquidity of your investment with your potential need for the cash. It is a simple rule that can save you from a lot of stress and financial pain down the road. Our eighth point is a strategic one. Don't treat all bonds the same. It's easy to lump fixed income into one big, boring category. But the reality is that the bond market is incredibly diverse. A US Treasury bond behaves very differently from a high-yield junk bond, which behaves differently from an emerging market bond. They have different risk profiles, different potential returns, and they react differently to economic events. For example, in a recession, safe haven government bonds usually do very well, as investors flee from risk. High-yield bonds, on the other hand, tend to suffer as the risk of default increases. The mistake is not understanding the specific role each type of bond plays in your portfolio. Are you using bonds for safety and capital preservation? Then, government bonds are your best friend. Are you using them to generate higher income and are willing to take on more risk? Then a small, diversified allocation to high-yield bonds might make sense. Don't just buy bonds. Buy the right bonds for the right job within your overall financial plan. Next, our ninth don't is about taxes. Don't ignore the tax implications. Not all bond income is created equal in the eyes of the tax man. The interest you earn from most corporate bonds and treasury bonds is typically taxed at your ordinary income tax rate, which can be quite high. However, interest from municipal bonds issued by states and cities is often exempt from federal taxes. And if you buy a municipal bond issued by your own state, it might be exempt from state and local taxes too. This can make a huge difference, especially for high-income earners. A 4% tax-free yield from a municipal bond could be equivalent to a 6% taxable yield from a corporate bond, depending on your tax bracket. So, when comparing bonds, always look at the tax equivalent yield. This allows you to compare apples to apples, placing the right type of bond in the right type of account, like holding taxable bonds in a tax-advantaged retirement account, is a smart strategy to maximize your after-tax returns. Don't give away more of your earnings to taxes than you have to. Finally, our 10th and last don't set it and forget it completely. While fixed income is generally a more stable part of a portfolio, it's not something you can just buy and ignore for 30 years. The world changes. Interest rates fluctuate. Inflation comes and goes. And the credit quality of companies and even governments can change over time. That A-rated company you invested in 10 years ago might now be a riskier BBB-rated company. You need to periodically review your fixed income holdings. At least once a year. Take a look at your portfolio. Has your risk tolerance changed? Have your financial goals shifted? Are your holdings still aligned with your strategy? Rebalancing is also key. If your stocks have had a great run, you might need to sell some and buy more bonds to get back to your target allocation. A portfolio is like a garden. It needs regular tending to stay healthy and productive. So there you have it, the 10 biggest don'ts of fixed income investing. Avoid chasing yield blindly. Respect inflation. Diversify your holdings. Understand interest rate risk. Don't panic sell. Watch the fees. Consider liquidity. Know the role of each bond. Be smart about taxes. And review your portfolio regularly. By avoiding these common traps, you'll be miles ahead of the average investor and on your way to building a truly robust and resilient fixed income portfolio. Thank you so much for watching. If you found this guide helpful, please hit that like button and subscribe for more content to help you invest smarter. Let me know in the comments which of these mistakes you found most surprising. See you in the next video.